Good morning, everyone. My name is Sakiba Ryan. I'm the crude oil trader here at JNF Capital, looking to give you an insight into the financial markets and especially crude oil today. The day today is Monday, 23rd February 2015. Before I get started, I'd just like to read you a quick risk warning. Please note, investing in the financial markets is not for everyone, as losses can exceed deposits. Now, what I try to do for my clients is, as I've explained before, the markets are made up, of bulls and bears, buyers and sellers. So what I'm looking to do is simply identify which entity is in control of the market and align my funds in the same direction as whatever they're doing. The market has been very interesting for the last month, very slow in terms of directional trades. It's been range bound, really, stuck between 49.90 and 53.94. Now, this is what I like to call in my oil reports a neutral zone. It's really a battleground for where the bulls and the bears are having it out. Generally, when they have a very similar argument in terms of strength, you'll find the market will get stuck in this range. And what I like to do is generally trade it when the market starts to lean to one side, be it the bullish or the bearish. Now, from the current theme in the market at the moment is, on Wednesdays we get the crude oil inventories that come out from Cushing, Oklahoma. So they've been building, the inventories have been consistently building. So, the market turns bearish. And then on Fridays, we have the rig count that comes out from Baker Hughes. And, rig counts have been dropping, and that's fairly bullish for the market as far as, the majority of traders think it is anyway. So this consistent range is just, has taken place the whole of February, and we're looking for a clean break. The inconsistency in where even some of the big institutions think the market is going is quite tremendous. If you look at Barclays, their average price for crude oil is somewhere in the region of about $43. Deutsche Bank has an average price of about $67, and you've got Citibank that has an average price of about $35. So that's just it's a very big range, nobody seems to be in agreement as to where the market is going. So let's see what the arguments are for, at the current period of time, and then try and make a decision as to which direction we're going to be trading this. Okay, so let's start with the bears. What are the bears looking at, at the moment? So, like I said, inventories come out on Wednesday at around 3:30. Last week was specifically interesting, and I'll explain why. We were expecting a build in inventory somewhere in the region of about 3.3 million barrels. Okay. However, on Tuesday night, we have what is a report released from the API, okay, the American Petroleum Institute. Now, their figure is usually a precursor to the EIA figure that comes out on Wednesday, okay, which is the government figure. Now, the API figure was suggesting that the oil inventories would build somewhere in the region of about 14.3 million barrels. Now, on the back of this, Tuesday night, Wednesday morning, crude oil dropped about $4, $4.50. That's a 400-point move, okay? In anticipation that the inventories will actually build, not just 3.3, they will actually build somewhere in the region of 14.3. However, when the government figure came out, it was a build, and it was a build of somewhere in the region of about 7.4 million barrels. Now, despite the fact that this was a massive build, one of the highest builds we've seen on record at the moment, it wasn't as big as the 14.3 that was potentially suggested by the API the day before. So what happened was the market actually got bought back. It was a lot of the shorts took a lot of their profits. Instead of dropping the market further, it actually raised the prices slightly. Now, if you break that down, 7.4 million barrels is still a massive build, okay? By every means, it's still a very bearish figure, okay? That's the 7th straight build we've had, now bringing the tally up to about 426 million barrels, okay? So massive builds coming up, building in Cushing, Oklahoma, and stockpiling. Okay, so now the next thing is on Friday we had the rig counts released. Now I'm currently interpreting the rig count slightly different to everyone else. A lot of the traders, speculators out there will just interpret the rig counts for what it is. A drop in rig counts directly implies that the price should go higher because there's fewer rigs in play. What I'm looking at is the actual production from the rigs. Okay, that is very, very pivotal. Now, well, basically last week the rig count dropped by about 48, bringing the tally to somewhere in the region of about 1310 now, 1,310 rigs in place. Now that should be bullish for the figures, for the price of oil. However, what I have noted is that, of course, first of all, the pace at which the rigs are dropping is slowing down. Previously, last week, we had a drop of about 83, and before that 94, so it's been quite consistently high. Recently, like we've seen last week, it's come down to 48. But the more important thing is that, like I said last week as well, according to the EIA, the rigs, especially in the Balkan region, are still producing at record levels. And if you drill down into that, try and find out why they're doing that, you'll find that a lot of the producers are forced to keep their drilling going at full tilt due to their lease agreements, so that they don't lose the rights to their acreage. Now that's very key. Even though the rigs are coming down, what it seems that their main rigs are still producing at full tilt, if not even climbing in the amount of production that they're doing. So this data that we're getting from Baker Hughes about the rig count has to be interpreted carefully, as far as I'm concerned. Now, another thing that we're looking at is seasonality. Now, in the second quarter, we generally tend to see weaker demand for crude oil product, okay, which leads to a lot of refineries shutting down for maintenance. Now that obviously pushes stock inventories even higher. Now if you've got stock inventories going even higher due to weaker demand, refineries shutting down due to maintenance, and then you've got figures like out of the PIRA last week that suggest Saudi Arabia's production went up again, okay, and is somewhere in the region of 10 million barrels. Now, according to my previous report, I saw that it was around 9.7. Now it's looking like it's somewhere in the region of 10 million barrels. Production is going up, demand is slowing down. It does paint a very bearish picture from what I see. So, as I explained previously, the only way we're going to get higher prices is if somebody cuts production, either by policy or if they're forced to simply cut production by default. Okay. Now, what I'm looking at the moment is we're having some geopolitical tensions in Libya. Okay, Libya is probably the second largest oil producer in Africa, with a capacity of somewhere in the region of about 1.3 to 1.5 million barrels. Now, due to the current geopolitical tensions going on in Libya, rebels and the government fighting it out, their production has dropped to somewhere in the region of about 300,000 barrels. Okay, so that is a cut in production. So as far as that particular isolated situation is concerned, that is a fairly bullish scenario that we have there. Okay. Some of the things that I said last week are still valid this week. Okay, for instance, OPEC has released a note saying that their own demand for their own product is going to grow by about 120,000 barrels, due to the slump in prices, and they also estimate that the growth of non-OPEC production is going to slow to roughly in the region of about 860,000 barrels. Okay, so on one hand, saying that their own production is going up, and then on the other hand, they're saying that the non-OPEC production is going to start slowing down. Another thing to look out for is the Fed minutes. The Fed minutes indicated that the Fed is not very comfortable with the strength of the dollar. The dollar has been, exceptionally strong over the last few months, primarily because the U.S. have stopped quantitative easing, and that obviously strengthens the dollar. And now they're actually looking to raise interest rates at some point. So that gave a big boost to the dollar. Now, the dollar is inversely correlated to crude oil. So the stronger the dollar gets, the weaker oil gets, okay, generally, because it's priced in dollars anyway. Now, the fact that we're seeing that the Fed is now indicating they're not too pleased, not too happy with a very strong dollar, that gives traders who look at that correlation, it makes them a little bit edgy, a little bit nervous, so to speak. So, like I said, the market is trapped in between this range. Okay, bulls have a sensible argument, so do the bears. We're looking to see who's going to take control. So how am I trading the market this week? So as I explained, market is sideways. The whole of February, the market has been sideways. It's stuck between 49.90 and 53.94. Every time the market gets to 49.90, it gets bought back up to 53.94. Now, what I'm looking to do is obviously trade on a breakout of these levels. Okay, I don't like to engage the market when the market is in the battleground where the bulls and bears are battling it out. I call that my neutral zone. I don't like to engage it. It's just not a high probability zone to be trading. Okay, there's a lot higher probability trades out there. Okay, now if you'd like to know my exact entry levels, my stop loss levels, my take profit levels, once we get these breakouts, okay, please get in touch or using my contacts on the following screen. You could get directly in touch with me. A member of my team will get in touch with you and and help you set yourself up and gain you access to the oil report. Alternatively, you could, or alongside it, you could follow me on Twitter as well. My handle is @OrionOil. It will also be shown on the next slide. I do tweet out all the current pieces of data that come out that affect the price of crude oil. And occasionally I do give the exact levels that I'm trading so that you can monitor a little bit of my performance, even though you're not registered with us. So it is worth your while to follow me on Twitter as well. So that's all for me this week. Thank you again for joining me this week. Looking forward to seeing you next week.